And good morning, everybody, and welcome to today's Monday morning mortgage message. And I am Sean Woolen here, coming to you from Cherry Creek Mortgage on the Woolen Mortgage team. And today I am going to go over what is going on with interest rates, what's up with this market, and some tools to help you as you navigate through this crazy space that we are living in right now. So let's go ahead and get started with the current market update. And we will go here as soon as this starts to allow me to move forward. There we go. So interest rates. I want you guys to take a snapshot of this with your phone. Use your app on your phone to take a picture of this QR code. That'll download the Mortgage News Daily website app to your phone. It's a great app to give you a lot of industry-leading experts' opinions on what's happening with the markets, where interest rates are. It's just a great tool to have at your fingertips. So if anyone asks you what's going on with interest rates, it's a quick snap and then there you are. It's unbiased. It's just mortgage news. It's great. I use it all the time, and it's just a good tool to have. So go ahead and take a picture of this and go ahead and download that. So we're talking about inflation. This is the inflation since March of this year to April of last year. And I want to talk to you about what's going to happen in the near future here. So as you know, inflation numbers came out and they were at 1% for the month of June. So the markets did not like that because it was higher than expectations. But what it also did is it replaced a 1% rate with, it replaced the 0.9% rate. So it replaced a lower number, which meant the overall averages went way higher. What I'm worried about is the new inflation data that's going to come in for July is going to replace a really low number, and so is the number in August. They're both very low numbers. So if we have another high inflation month of over 0.5%, that new number, let's just say it's 1% again, that new number will replace 0.5%, and then the average will go up, and the overall inflation annually will be a higher number, and that's what I'm worried about. So a lot of people are thinking that maybe inflation numbers are behind us, when in reality, I think we could have a rough summer for inflation. So we could see rates go up a little bit more, unfortunately. And then look at October. We had some really high inflation numbers a year ago in October. So I hope the Fed's moves will really help us bring inflation down over the next couple months, so that we can have a low number to replace this high number, and then our averages will come down on inflation, and that will really help interest rates. Because remember, mortgage rates are a direct correlation with what happens in the bond market, and the bond markets hate inflation. So the lower the inflation numbers, the better mortgage rates will do. Also, you might have seen the recessionary pressures that we have had. I want to kind of go over what that looks like right now. This right here is the last quarter. The first quarter, we were negative GDP, negative 0.4% on the GDP. Two quarters in a row is the definition of a recession. So I honestly believe that we are in the recession, and that the data is just behind, and we're a little in front of it, because we're all feeling the pain of the pump. The cost of living has gone up tremendously with the cost of goods, groceries, you name it. And it is putting a strain on us. We've seen the stock market come down. Everything's condensing right now. And I believe that this quarter will, even if it doesn't go negative, I think we are in a recession or in the very beginning stages of it. So keep your eye on that. But inflation coming down and a recession, that will bring interest rates down. So I believe, and this is my belief, I believe in the end of the third quarter, fourth quarter, we're going to see rates come back down. So if your buyers are waiting, don't wait, because we still have big institutional buyers out there. They're still buying up the properties. Appreciation will still continue to happen. And I honestly believe that we're going to see a more normalized appreciation of the 3 to 4%, which is healthy. So if you wait, you're going to miss out on that as well. Plus, you're going to miss out on the amortized payments that you're making where you pay yourself. So there's a compound missing out of a potential equity and a potential value and savings that you can put in your pocket by the equity you create yourself. So let's have a look at the next slide here, which is very interesting as well. This is what we're used to. These were the expectations of people over the last 6 months. These were the forecasts for the second quarter of this year by all the major institutions. Check this out. Wells Fargo was expecting us to be in the low fives, which was the highest. Freddie Mac in the high fours. And where are we? We're at 6%. So nobody got it right. And this was just recent, a very recent one. This one over here projected we'd be in the low fours. If you look at the quarter, we're in the second quarter of 2020. They thought we'd be in the mid threes. So as you can see, these numbers are way off. Everyone's expectations were off. And everyone in the public is seeing these on the news channels and everything. I mean, here it is again. These are all major people that understand the industry very well. And these are all predictions in the fours for 2022. Here's another one. They were predicting in the second quarter of 2022, 3.43. So everyone's expectations are absolutely blown. And that's one of the reasons we have this weird pause that's going on with the markets, is people just don't know what to accept. They don't know if they're going to come back down. They just don't know. So they need us to help give them the knowledge. And here is a really interesting numbers on what it impacts their purchase power. So let's look at the rates in the 3%. If they were pre-qualified with rate at 3%, they could afford 530. At right now at 6, that qualification number to keep the payment the same has dropped all the way down to 390. That's a major difference. So yes, it's making a big impact on people. The expectations are blown. So if you were told 530 purchase price and now you're at 390, you're probably saying this isn't worth it. I'm not going to even try. But if you were never told that you could qualify for higher, you would just say, yep, you qualify for 390. You have no set expectations that are blown. Those are your expectations, and you're going to be fine with it. And that's what we're seeing with all of the buyers that are just now coming into the market. Now, all of the buyers we've been working with for the last 6 months to a year, they're in a weird space psychologically because their expectations are just blown. But this is good information to at least show. This is the spike. Yes, it's quite the spike. Nothing we can do about it right now. We have new expectations. I honestly believe rates are going to come back down towards the end of the year, but it wasn't a slow spike, so those expectations were lost pretty quickly. But I want to go over the seller buy down. This is a phenomenal tool that I think you can really utilize that's not being utilized properly. So I'm going to go over through this in detail. Here we have a standard purchase, okay? The new home they're looking at, it has a listing price of $750,000. Let's just say they go full price. This is what the numbers would look like if they made a full price offer. $750,000, 20% down, $600 loan amount, current rate 6%. You're talking a mortgage payment about $4,097. This is a current model full price offer on a normal home at $750,000 asking price. But what if you wanted to make an offer a little bit lower? The market's softening a little. You want to make an offer a little bit lower? Let's look at that. So let's just say you made a 3% below asking offer, $727,500. What does that payment look like? You save about $100. So it's about $108 that you would save per month by making the lower offer with the same down payment, 20% down. But let's do something unique. Instead of going 3% lower on the asking price and the offer that you make, let's make a full price offer and ask the sellers to give you that 3% down as a seller credit to buy your rate down. In this model, you would get a rate 1.375% lower, and look at the difference in APR. You get a much lower interest rate, and look at this payment. It is $510 a month cheaper. So if your buyer is looking to get a great deal by getting a really low rate, the $512 difference in payment is dramatic. So this is a way to, in today's environment, get a much lower rate and really help your buyers with their cash flow on their payments. And look at this. This is really interesting as well. The income needed to qualify for a normal loan up here in today's market, this scenario would require $98,000 annual income. This rate reduction, only $86,000 of income needed. So this is really going to help bridge the gap for those people that are maybe with builders right now when rates have gone up. Utilize that builder credit to buy the rate down to get back to where they may have been before in payment and to help them qualify, because a lot of this rate hike has pushed these buyers out of the market because they can no longer qualify. this tool can help them get back in the game. Now, this is another interesting scenario. In order to get this payment right here, $3,584 in today's market with today's rates, that would equal a purchase price of $643,000. So $643,000 purchase price with today's rates would give you what this seller buy down would give you in payment. That is huge. That means that in a $750 purchase price, you can get the same payment as what you should be getting with a home that's $100,000 less in price. That is a massive saving. So utilize this seller buy down. If you don't understand it, reach out to me. I'm happy to go over it in detail. And I'm going to also now share with you a little bit of what's going on with the markets. This is the last week that we had. So this was unbelievable. Let's look at this real fast. These were the candlestick charts to kind of show you the bipolar nature of our market last week. When the Feds raised the Fed funds rate by 3/4, we saw the bond market have a massive rally. It went up, I think, 120 basis points for that day. This is a tremendous move. And we saw just a couple days before a loss of about 175 basis points in a 2-day swing. So if you look at how much we lost those 3 days, that is an equal 100.57 compared to 98. That's 254 basis points. So basically a loan that costs no points on this day, 3 days later, that same rate costs you 2.5 points to get. So it was very volatile. All of the mortgage people were drinking heavily. It was because it was hard to watch. It really was. And but we got some recovery once the Feds raised the Fed funds rate. Remember, when they do that, it hopefully will slow down inflation. The bond market loved that, and mortgage rates actually got better on the heels of them raising the Fed funds rate. Interesting information. And we're kind of flat right now, but we saw a big spike in interest rates. We got a little bit better. So now we're right around the hovering about the average of the 6% rate. If you look at the Mortgage News Daily, which I like to always reference. Let's look at that real fast. Mortgage News Daily. Here we are with the mortgage rates current. We're at 6.03, basically at par with a credit of 0.02%. So this is where we are today. Rates are higher than they used to be. They're a little bit better on the heels of the Feds raising the Fed funds rate. Let's hope that inflation can go down. I think the summer is going to get a little ugly for inflation, but I think towards the end of the second quarter into the third quarter and quite possibly into the fourth quarter, we'll see rates come back down. So that's today's mortgage news update, mortgage rate update. If you have any questions, you can always reach out to me direct. Have a great day, guys.